What's up? Today we'll be taking a look at the Meet Kevin Pricing Power ETF, ticker symbol PP. In this video, we'll do an overview of the ETF objectives, portfolio composition, cost, and at the end I'll give my own opinion on the ETF. I'll state whether or not I'm buying it and why. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, if you want some free stuff, feel free to lurk below and check out the links in the description. You can get free stocks, also a free $30 to sign up with Rakuten, a site where you can earn cash back on everyday purchases. For those that don't know, Meet Kevin is Kevin Paffrath. He was originally a real estate agent and then a real estate investor. He started a YouTube channel to share his real estate know-how, which has since expanded to other personal finance topics such as building wealth generally, taxes, and stock investing. He ran for governor of California, has been a CNBC contributor. He started a real estate company, House Hack, and now he has an ETF. I followed Kevin for a few years now. I think he's an incredibly productive, incredibly efficient, and overall smart, hardworking guy. But is the ETF any good? Let's get into it. This is an actively managed ETF that invests in companies of any size that are deemed to be innovative and have greater pricing power than their peers. Pricing power is a term that describes the effect of a product's price change on the quantity demanded of the product. Ideally, firms with good pricing power can increase prices and not see a significant drop-off in demand. This is closely linked with price elasticity of demand. Price elasticity is a measure of the degree to which individuals, consumers, or producers change their demand or the amount supplied in response to price changes. So if consumers are willing to buy a product regardless of the price, take for example life-saving medicine, then this product is deemed priced inelastic. If consumers are unwilling to buy a product even with a small price increase, take for example products that are completely homogeneous, the same, this is called elastic demand. So PP assesses companies based on price elasticity and picks those believed to have the ability to increase prices on consumers without too much ill effect. Using a proprietary methodology, the fund picks firms that focus on the development of new technologies, firms that increase consumer engagement, and firms that take a disruptive approach to business growth. This sounds very much like the Cathie Wood ARK Invest approach. Additionally, the fund uses a bottom-up analysis to select firms with above-average growth potential. At times, the fund may invest up to 30% of its assets in targeted ETFs to provide a macroeconomic hedge against anticipated market risks, such as geopolitical and extreme weather events, as well as the Federal Reserve monetary interest rate movements. According to Kevin's own words, the vast majority of companies that we invest in, we're looking for positive cash flow, free cash flow, earnings per share, and growth. Anything that ensures these companies do prove pricing power. Alright, so that's the overall vibe of the ETF, an active approach that focuses on innovation and good pricing power. So let's move on to the portfolio composition. But before I do, I should point out that I have followed Kevin's stock trades for a few years now. He tends to be a pretty active trader as opposed to a long-term buy and hold investor. He makes moves based on the current macroeconomic environment and based on where he sees things moving. Most notoriously, he sold his entire stock portfolio in March of 2022 in an attempt to buy back lower. He got a ton of criticism for this, being called a flip-flopper and a market timer. As we know, the general advice is that timing the market beats timing the market. My point is this. Not only would I expect him to manage this ETF with the same active trader's approach, but also as a disclaimer that anything you see in this video about the portfolio composition of this ETF could be out of date very quickly. Alright, so this ETF currently has only 21 positions. Almost 90% of holdings are US based, it leans very large cap, and has a heavy bias towards growth as opposed to value. Almost half of this ETF is information technology, 30% is consumer discretionary. The semiconductor industry is definitely well represented here. Maybe you could argue that over 20% in the semiconductor industry is too much, but semiconductor stocks have been some of the best performers over the last 10 years, and the industry is home to some of the world's best companies. Because there are only 21 positions, we can take a look at the whole list of all of them. For actively managed strategies, it's not uncommon for there to be so few holdings. If you have too many from too many different sectors, you essentially become overly diversified, and therefore you become the index. And I don't mean to hate on diversified index funds, but that's definitely not the purpose of this ETF. But just as a comparison, ARK, an actively managed ETF by ARK Invest, has a little over 30 holdings. And the rule of ARK Invest is that no company can be over 10% of the weight. However, when we look at PP, 23% of this ETF is currently in Tesla stock and 14% is in Apple stock. So almost half of the exposure is in two companies. You can make the argument, why would I pay a more expensive management fee when I could just own these two companies myself for free? But at the same time, the portfolio composition of this ETF is subject to change. As the manager trades in and out of stocks inside the ETF, You don't have to pay tax on this if you're just buying and holding the ETF. You only pay taxes when you sell the ETF for a gain. If you were to trade these stocks yourself, you would have to pay taxes on any gain you have. Additionally, this ETF can provide options for anyone looking to tax loss harvest Tesla stock. My last video was on tax loss harvesting if anyone would like to see some more. An investor could sell Tesla at a loss in order to offset taxes owed on investment gains or personal income, and then buy PP, which has significant exposure to Tesla stock. But while PP has similar exposure to Tesla stock, it will not be seen as substantially identical, and therefore it will not violate the wash sale rule. Again, if this doesn't make sense, please refer to my last video. As far as the outlook of these companies, I can't claim to be an expert stock picker, but we can at least do a brief overview. Tesla and Apple are great long-term companies, but if we go through a bigger recession, they could definitely feel some short-term hurt. But these are definitely companies with good pricing power. 8% of this ETF is in the 2-year Treasury ETF, so this may be just a place to park some cash if Kevin thinks that the market could fall some more, and then it could be reallocated to other positions. 7% of this ETF is Taiwan Semiconductors. This is a great company, but there's definitely concern with the whole China-Taiwan situation. 5% of the portfolio is short the US dollar. The US dollar has been very strong this year, so a lot of people think that it has peaked, it's had its run, and it will be going back down. This looks like a short-term trade to try and capitalize on this. 4% of this ETF is Enphase Energy. This has been an incredibly strong stock over the past few years, but it doesn't exactly trade cheap. A declining housing market could hurt this stock. We'll have to see what happens. Additionally, we have AMD and Nvidia, both well-run, strong semiconductor plays. I will say, Occidental Petroleum Corporation is a bit of a weird one. One of these things is not like the others. So I don't know if this is a typo or what, but I certainly wouldn't expect to see an oil and gas company to be thrown into this mix. Apart from that, I think this ETF very much does what it says. Many of these companies do have very strong brands and can command better pricing power. Additionally, I believe the theme of disruptive technological innovation is very well represented. I think it's also fair to say that while both PP and ARK Invest ETFs have this theme of disruptive innovation, the companies in PP tend to be a bit more mature, which I think is a good thing. Many of the companies in the ARK ETFs are more moonshot companies that will absolutely fly in a risk-on bull market, but get crushed in a risk-off bear market, as we've seen recently. I would expect that the list of stocks in PP would provide maybe better risk-adjusted returns than something like ARK. But let's move on to cost. Again, this ETF is actively managed, which tends to not be cheap compared to passively managed ETFs. Active managers follow market trends, shifts in the economy, changes to the political landscape, and any other factors that may affect specific companies. This data is used to time the purchase or sale of assets, with the intention being to outperform the index. Because it's very much more work, actively managed ETFs tend to have higher fees than passively managed ETFs, which simply aim to follow the index. PP charges 77 basis points annually. The average actively managed ETF charges 69 basis points, so PP is in the ballpark of what you would expect, but a little bit more. Just for comparison, the ARK Invest ETFs charge 75 basis points for active management, except it looks like ARKW is now 88 basis points. But we can't sugarcoat it. 77 basis points isn't cheap, especially when you consider the compounding opportunity cost of money lost due to fees over a long period of time. This calculator shows the concept. Assuming equal returns of 10% a year, $6,000 a year invested into a 77 basis point expense ratio ETF will cost you almost $500,000 more in fees over 40 years than that same $6,000 a year invested into a 4 basis point expense ratio ETF. Granted, a 4 basis point expense ratio ETF is what you would expect from a passively managed broad market ETF. So it's definitely unfair to assume that PP and a broad market ETF would have equal returns. These ETFs will trade very differently. Anyone that buys this ETF is hoping to significantly outperform the market to the point that that management fee is very much in the noise. The problem with this idea is that 84% of active managers underperform passive benchmarks after 5 years. That jumps to 90% after 10 years and 95% after 20 years. So the long-term statistics on active management are definitely grim. This, in combination with high fees, is really my main problem with this ETF. It's the reason why I personally won't be a buyer. Again, I think Kevin's a very sharp guy. I like the strategy of focusing on innovative stocks with high pricing power. I think there's a lot of stocks in this ETF that will do well in the long term, but I can't ignore the fact that active management just tends to underperform passive benchmarks. Could this ETF be the exception to the rule? Sure, but I certainly can't count on it. For this reason, I keep the vast majority of my portfolio in low-cost, passively managed ETFs. I do, however, buy individual stocks with the bottom 10% of my portfolio. Instead of buying this ETF and paying the management fee, I'd rather just pick a few of my favorite stocks from PP and just buy them on my own. Sure, I don't have the benefit of a fund manager managing the stocks for me, but long-term buying and holding stocks is typically the best way to build wealth anyway, as opposed to actively trying to trade in and out of them. As far as the tax implications of buying these stocks outside of the ETF wrapper, I usually only buy individual stocks in my IRA anyway, and I keep ETFs in my taxable accounts. So that's just my 2 cents, but it will certainly be interesting to see how this ETF does over the coming years. But if you found this helpful, consider hitting the like button. Subscribe for more content like this. Again, also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued at $2,300, $30 with M1 Finance, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial or tax advice, just entertainment purposes only. So thanks, and I'll see you in the next video.